What's up, guys? Back with another video, filming back to back. Probably gonna do another 4 round trip of videos. So let's start with the second one. This is gonna be risk of property investing. So my last video was renting versus buying now owning. We're sticking with it with properties and property investing. So let's say you want to buy a rental property. You're saying, wow, I'm gonna go ahead and have some passive income come down the line that I can pay off this property and then have it as free cash flow. Cool. So here's the risk of it. This video is not to scare you. This video is not to tell you not to do it or what to do. I'm just telling you there are risks associated with this because yes, I feel like a lot of us want to buy properties. A lot of us want to invest in a property. That's fantastic. That's fabulous. I say go after it if you have the capital, but just understand you're not going to have it as easy as cash money, put down, find me a renter, everything's perfect. No. So here are the risks. So number one, real estate market mishaps. Here's what's going to happen. When you're investing in a property, you have to understand the real estate market now. For example, here in Florida, it's just that it's so high and everything is not really where it's supposed to be. And so what am I saying? I'm saying that properties now are either overvalued. It's oversaturation of the market. Some properties here in Tampa per se are worth, let's just say you have a regular property that's on a suburban neighborhood. It costs maybe $400,000, $450,000, almost $500,000. And it may not be as bad as per se California prices or New York prices, but down here in Florida with the cost of living, how wages are, in a nice suburban neighborhood, maybe the house should be like 250, 300K, but it's almost $500,000. And that's because just, people come in, these investors come in, they buy out these properties, they raise them up, and people need somewhere to stay. So like, well, I just got to pay top dollar. It is what it is. But just understand that if you're buying an investment property, know its fundamental value, its true value. Know the value that it had before this whole housing boom. Know that if the value goes down, you can at least attempt to recover some of it, or you can have it stabilize. But you don't want to take a hard loss on your investment in case of this housing bubble bursting anytime soon. So just understand your market, understand where you're buying, understand where the investment is going to lie. Some cities might have a hold of an investment and you'll say, well, this is awesome. Maybe you want to invest somewhere down in South Florida. But you also have to know where. You have to know location because location is necessary. Some areas might originally be very cheap, but then it says, oh, well, they're building around it. So now they're driving the property values up over at the place that you're looking at. That is true, but at the same time, those properties were valued XYZ amount beforehand, before this housing boom, because that's what they're worth. Now, because everybody's building around them and people are just buying up these properties, charging top dollar, say you need somewhere to stay, right? Pay the money or be homeless. It's pretty much how it is now. Just know when you're investing in something, please understand the fundamental value of it. I cannot stress that more often than I can do now, but find the fundamental value and understand what will happen if this housing market tanks. Will it stay stabilized? Will it go down heavily? Understand the location, understand that real estate market, because it will help you. Don't just go and put money down on a house and say, I'm good to go. I can find me a renter. Somebody needs somewhere to stay. You have to think smarter than that. Think ahead 10 steps, not 2 steps. So second thing, rates might be high. Nobody wants a high interest rate. Let's face it. You don't want to be paying 9% or 10% on your house. It's just crazy. But when you buy a rental property, you have to understand, like, will you recoup this investment in the 30 years or maybe 20 years, 10 years? Depends on who's the buyer and depends on how long that's going to be for you, how much they want to pay, obviously, how much you're charging, obviously. But understand that if the rates are too high, you may or may not want to get into that. I mean, sometimes you may just say, well, screw it, go for it. But at the same time, understand the financials, the fundamental value. That's what I'm talking about. Understand the loan. Understand your loan amortization schedule, where you're going to pay this off in 30, maybe a little bit earlier. It depends on obviously what you do, but it depends on how you start first. So understand if the rate is high, you might want to try and find a better rate to be with. Sometimes you can refinance, but at the same time, just find out if a bank's helping you or whatever company's helping you. Find out if they can give you a good rate. Something maybe 3.5%, 4% maybe, but if it's like 7, 8, 9, you might want to reconsider things. Economic conditions. So I just talked about that. It's just basically saying that the market itself and what's going on now. So we have a lot of inflation going on. And with inflation comes higher prices. So whenever you have a higher price for a property, obviously when inflation happens, you think, oh, well, the wages will catch up. Well, not necessarily true to all states, because in Florida right now, the wages definitely are not catching up. And a lot of people are just complaining about Florida. But that's another video for another day, or inflation if you want to check that out. But regardless, economic conditions, understand what's happening in the world right now. Understand, is the property going to keep going up in value? Is it going to be appraised for a good amount, or is the property staying stagnant, or is the property going to decrease in value? You have to understand, like I said, location, understand the real estate market, understand what's going on in the economy right now. Will your house be affected by a downward turn in the economy? Because as we've seen, things happen during COVID. Yeah, things kind of, went down the economy, but ultimately the housing boom just went up here in Florida. And it's been very expensive, but at the same time, know your economic conditions when you're buying. Know your supply and demand. Okay, let's say you're buying a whole bunch of rental properties, okay? You might have 1,000 units, but those 1,000 units in demand. See, and I'm gonna get into this more when I talk about the second point after this. So the next point is location. I already spoke about that. Just know where you're investing in. If you're going to invest in a suburban area, please know that all the houses might have the same type of build or stature, or made by the same materials. So if somebody's charging XYZ amount to, like, say 600K, and you say, well, the house next to it is like 450, see if you can say something about it, talk to them about it, because you obviously don't want to overpay. Remember, before you think about yourself as being a person, I'm going to charge a lot of rent, I'm going to charge people out the wazoo, just think about how much you have to pay. Think about what you're doing, your initial investment compared to everybody else. You got to think about yourself first and understand that if I don't want to pay a lot of money for this, then I'm pretty sure I don't want to charge a lot of money for this, because that wouldn't be right. You don't want to get screwed. You don't want to screw anybody. So understand your location. So supply and demand with the negative cash flows I want to speak about. So more money out than more money in. So that's supply and demand. You have 1,000 units. Say you have 1,000 apartment units, okay? And there's no high demand in that area. Let's say you have 500 people come in and say, oh yeah, we want those. You sell the 500. You have 500 vacant now. So with that, you're pretty much spending money on these units, and it's going to waste because, well, you only found 500 people to afford it, or 500 people that want to buy into it. Whereas now you have all these other units, and you're pretty much losing money in your investment. So you're probably like saying halfway I'm there, but halfway you're not. So when it excuse me, when it comes to supply and demand, just understand more can be better when you have a great market and great economic conditions, and you understand everything about real estate and you understand everything about property investing. But when you have poor economic conditions, or you have a unsuitable market where people would not be able to afford things such as they would have before, you got to know when to have the right investment and how much of it. So here's the negative cash flows. That's another risk. Okay, and remember, this video is not intended to tell you no. This video is not intended for you to feel like you're doing bad at property investing. It's just to let you know, hey, everything's more than just peaches and cream of buy, charge somebody, and get back your money. So negative cash flows. So you might have a high vacancy rate, which means you need high demand. Because like I just said, you could have 1,000 units, but 500 are filled. So where are the other 500 going to go to fulfill that 100%? Or maybe you want to be 80%, 90%. You're trying to build it up to 100. What are you going to do about those vacancy rates? Because you obviously say, well, I can't just charge low budget rent and then have people, not recoup my investment for me. Obviously, there's a certain line when it comes to the financials of things, when it comes to being a person that's selling, or, well, not selling a property, but you're renting to somebody. You're having somebody buy your property, not buy a property, but rent to you. Excuse me. So the thing is, when you have all these high vacancy rates and your units are not being filled up, you need to know, am I in the right location? If you're not, you have to know beforehand about that. You have to say, well, if I'm going to build something, you have enough money, let's say you have enough equity to build apartment complexes, okay? You're going to put them in an area that's suitable. Now, I have a mindset or a thought that can really help. That it's not about screwing people over, but it's about knowing where the best opportunity is. And I would say just find areas that you know that people are going to flock to, people that are going to stay there for a while, where you can have renewed of leases, and then people won't really complain. Not saying charge them out the wazoo, but just know that foot traffic, eye traffic, people want to buy pocket traffic, and too costly maintenance. So, excuse me. Once again, negative cash flows, too costly of maintenance. So whenever you're spending more, you're saying the property's breaking down, too much of a heat wave, AC's going out, I gotta fix refrigerators, I gotta fix this and that. When you're buying that property, just remember you have to incur those costs. Because now somebody is paying you money to rent, so now you gotta incur those costs. You're the landlord. It's not their property unless you want to sell it to them. But now you're the landlord. So whatever they say is broken, unless you got in a contract stating they have to fix it, or you guys have to go back and forth depending on how it was broken or anything, you're gonna have to incur the maintenance costs. And if you feel like the rent's not helping recoup that, you have to understand what needs to be fixed. You can't just go and say, okay, money out, money out, money out, but then you're charging low rent or you don't have enough associated costs with that. Now, not charging enough rent is the last point here. Obviously, I would never want to charge somebody out the wazoo or charge somebody a high rental price because, like, oh, everybody else is doing it. No, you have to understand who your people are, understand demographics, understand location, understand the equilibrium of the market. You can't just go and say, oh, skyrise, let's go into a surplus and let's go ahead and charge everybody else. No, you have to understand, hey, stability right here, more people word of mouth, referrals, people want to come to your properties, they want to come buy from you. Because if you're charging them so much money, people are going to say, I hate this, I don't want to have this person be, my landlord anymore, I wouldn't want to recommend them. So it all ties into a whole loop. But at the same time, obviously negative cash flow is not charging enough rent. You can't charge people it's so low floor. You have to charge them like maybe a low ceiling.